Hello, this is Charles. I'm going to talk to y'all about the 10, it's really 12 things that really kill a mortgage application. Okay, so let's start from the top. Okay, the first thing is don't change jobs. Okay, so if you're in customer service, stay in customer service. If you're in the medical field, stay in the medical field. And because you're going to have to prove that you have job stability for 2 years. Okay, so you need to stay in the same field for at least 2 years. Okay, so don't go from a W two, which just means self-employed, to a 1099. That means that you're in business for yourself. And you can go from self-employed to W two, but just try to stay in your same field for at least 2 years. So you're gonna need a minimum of 24 months. Okay. Okay. The next thing is don't go buy a new car or a truck or van or RV. If you do, you may be staying inside of it. So don't go buy nothing new. No new nothing. Okay, so just wait until you buy your house and then you buy your new stuff. Okay. So the next thing is do not charge your cards excessively. Don't be running your cards over 50% of your limit. Because remember now, if you go over 50% of your credit card limit, it's going to drop your scores between 25 and 30 points. So you want to keep them like below 30% of your limit. It's nice to keep them like around about 5% because it really increase if you keep it like below 5%. But anyway, try to keep it below 30%. I know sometimes it's hard to do that, but it don't take you no more than about um, 45 to 50 days to buy a house to get financed and get approved. So if you can do that for about 60 days and get in your house, hey, that's the quickest way to do it. Just keep them balances down low. Okay. And now the next thing is don't be late on none of your payments, especially your credit card payments, because that's gonna if you late on any of your department store credit cards or your Visa, your MasterCard, those are credit score killers. I've seen some people lose as much as 65 to 85 points when they miss a credit card payment. Okay, so and don't be late on your car payment or your furniture payment, none of those, because those will really hurt your credit scores. And try to watch them collections because it, they, they don't look at your your medical bills too badly. They really don't care too much about the medical bills, but just watch those credit card bills because that's a definitely a mortgage application killer there. Okay, and the next thing is don't go buy no new furniture. Like I said, don't buy a new car, don't buy no new furniture. Wait until you move in your house. Okay, so and definitely don't go buy a water softener. Just wait until you close. Then you go buy all that stuff. Okay, the next thing is don't be applying for all of those different cards, department store cards, all of those different, like Sears, not Sears, but Targets and Walmart cards, and don't go do that because them inquiries they are really hurt your scores. They knock your scores down between 2 to 5 points each inquiry. So don't do that. And okay, so the next thing is don't make large deposits into your account. I mean, I know you're gonna have your tax returns coming back. I'm not saying like that because I had a lady. Her daughter was giving her like $2,000 deposits, but she was putting the money in there cash money. So she was putting like $2,000 in her account. That was really, and then she got to closing and she didn't have enough money to close because why? It's because that cash money has to sit in your account for at least 60 to 90 days. They call that seasoning. That was the underwriters call it seasoning. So don't put on cash money. Make sure they transfer from a checking account to a checking account or a savings account to a checking account. Just make sure they do it with wired from an account because the bank want to see where the money come from because that's all into the laundering, money laundering act. That when they dropped Twin Towers, that came into effect back then. So So don't put large deposits in there, and don't let nobody put no cash. Now, if you are short on your closing costs, I'm going to talk to you about a little bit about closing costs, because a lot of people don't understand the difference between the money, your FHA money that you put out FHA or conventional, the money that they're required to put down, your closing costs, your prepays. Those are three different monies that you got to have. Okay, so a lot of people get down payment assistance, and they don't understand they have to have some additional money. They get upset when they get closing, and they say, "Well, I got down payment assistance," and they tell me that I need to bring $35,000 to $4,000 to closing. What happens is you let's say if you buy a house for 200,000, the down payment is going to be 3.5%. So that's going to be $7,000. Okay, so this say you this we gonna just say just say for this course here, we're gonna say that you have a down payment assistance program that you're going through. Okay, so you're gonna give them like $1,000 down, EMD, earnest money deposit, take a house off the market. Okay, so then $6,000 to do it closing. Okay, so let's say that your down payment assistance pay for that $6,000. Let's say it covers that, but you still got closing costs and prepays. Okay, so let's say that you get the seller to give you $5,000. Okay, so closing costs is running between $6,000 to $8,000 on a home that's less than $250,000. Okay, so anything below that, you're gonna need $6,000 to $8,000 for closing costs. So let's say the seller give you five. So let's say you need eight. So you short three. So you're responsible for bringing the $3,000 to closing. So and that's going to be your closing costs or your prepays. That most likely going to be your prepays. Your prepays are the 12 months of taxes that you have to put in your escrow account, and the 12 months of insurance. A lot of times taxes run about $3,000 a year, because taxes run between $200 to $400 monthly around here in some areas. Some down in Nocatee, higher than that. So anyway, so don't get them confused. So in other words, what I'm telling you is don't buy a house broke. You cannot buy a house with no money. You want to have between $3,000 to $5,000 if you're gonna buy anything under $250,000. And if you get down payment assistance, that you're gonna need between $3,000 to $5,000 in your account, because you may have to pay closing costs, because when you buy a brand new home, all the bills don't pay your closing costs in your prepaid. They either pay one of them, they pay the other. They pay your closing costs, you don't pay your prepays, or they pay your prepaid, don't pay your closing costs. So it depends on and if you buy a pre-existing home, the seller will give you up to a certain amount toward your closing costs and your prepaid. So this don't. So I'm just trying, don't get those two numbers, those three numbers that are mixed up. Okay, the next thing is don't change accounts. Don't be putting your money in here and then open up an account here, because you have to have at least 2 months of bank statements that they're gonna ask you for, because they want to see where the money coming from. And definitely when you give them the EMD money, the earnest money deposit down, they're gonna want to know where that came from too. So don't tell nobody they can cash app you. So don't even do that. No cash app or nothing. Now, if you are short on your closing costs, you can get a gift letter from a family member. Make sure I get this straight. The gift member got to come. The gift letter and the money got to come from a family member. Okay, so and the gift letter will come from the mortgage company, and there again, you're gonna have to put the account that the money is coming from. If you need extra money, if you don't have enough money in your 401k, if you don't have enough money in your account, you can get the money gift to you by a family member. Okay, so I'm just giving you all everything today. I'm giving you all of the nuggets today. Okay, and please, whatever you do not co-sign on a car for anybody. If you do co-sign, they're going to count that payment against you. Now, some lenders will let you show them proof that you're not making the payments, but it's going to be hard if you co-sign for your son, your daughter, your sister, your mother, or your brother, and the money is coming out of your account. That's going to be kind of hard for you to prove that you're not making that payment. Okay, so that's it for today. All right, so we done covered the 10 biggest mistakes that you can make when you put in a mortgage application. Now, also, I can help you get a mortgage also. So before you lock your loan, hit me up. I may be able to save you some money on that. Okay, so this is Charles again, coming to you from Coast to Coast Mortgage. I see you on the other side. Bye bye.